the institutional case for Ethereum.
I started my career back in 2005. My background is very much Tradfi and very much ETFs. An ETF geek is what I am. The Intelligent Investor by Benjamin Graham.
The difference between an ETH total return staking product versus like a Bitcoin ETF.
They all go back to the foundation of 1930s book by Benjamin Graham, Security Analysis, right? So this marriage of the foundational TradFi principles plus marrying it to on-chain metrics is a very, unique combination that we haven't seen a lot of professionals in it.
But gold is also sort of hard to value, right? And, comes down to supply and demand. This is why we think, ETH is really interesting and kind of understandable. That's why it's such an interesting and fascinating asset.
The recent improvement proposal that came out with 1559.
It's a really great glimpse.
I love what you just said there. I think this is something people should really study. A lot of this token economics actually moves into like an on-chain financial statement. But Ethereum actually dropped in revenue during like a crypto winter last year. But it was actually, in terms of like on-chain profitability, it was the first year that it was profitable.
BlackRock and Fidelity have come into this space.
Super interesting. So potentially some FOMO from the institutions, Shiv. You heard that?
Yeah. We are so hyped up about the FOMO of institutional demand is now talk about risks like any prudent investor would. Does the question around decentralization come in? Like, is that also part of the risk that because Ethereum moved to proof of stake?
Yeah, for sure, that is important. But then I think this is where Solana has an issue that,
no upside, no risk, right? That's part of the game we're playing. I like the Robert Greer, like super asset class framework where you have the capital asset, commodity asset.
You can look at this like the internet bond and the risk-free rate of the internet. Offering investors and giving investors choice between both is important. So that's what we will maintain, having both products.
Would love to hear, just speak a little bit about the ETC group product that you recently released.
I think it's, over a year and a bit in the making.
But it's only when US launches and approves these products, that's when the big bang moment happens. And suddenly everybody else are like, what were we doing? Why didn't we invest in it?
People think that the first ETF was in the US, but it was actually Canada. And coming back to exactly what you said, Shiv, everyone sort of goes to the US and that's where the market is.
Welcome everyone to episode 19 of the Rundown podcast. I'm Shiv and you're welcome to your one-stop shop on all things crypto and on-chain analysis. And like always, I've got our friendly expert in on-chain analysis, Michael Nadeau, as my co-host with me. And this is the third time we've got a special guest, is it, Michael? Who we've got with us now.
Great to see you, Shiv. Yeah, it's good to be back. We do have our third guest on the Rundown. Excited to announce Chan Samadder. Welcome to the Rundown.
Hey, Mike. Hey, Shiv. Thanks for having me. Great to be here.
Great to have you. We recently published a report through the DeFi Report, the institutional case for Ethereum. And for this discussion today, super excited to get into a lot of details related to Ethereum. There's obviously an interesting narrative in the market with Bitcoin, with the success of the Bitcoin ETFs. This episode today, I think we want to get into Ethereum and what the institutional case for Ethereum could be. We're going to divide this into two parts today. But before we jump into that, Chan, I would love for you to just kind of share a little bit of your background, a little bit about ETC Group, and some of these interesting products that you guys are bringing to the market.
Yeah, sounds great. So yeah, I'm Chan Samadder. My background is very much TradFi and very much ETFs. So I started my career back in 2005, and the vast majority of it I've spent on the buy side, basically building, strategizing, selling ETFs. So I've been, the friendly term I think is an ETF geek is what I am. But I came to crypto very early actually, and I was introduced to it by a friend who worked in the industry very, very early indeed. And I'd love to say that, I immediately understood how profound and how impactful it would be. But at the time, I just finished my CFA level 3 exams, and I was ironically reading The Intelligent Investor by Benjamin Graham. And when my friend, after a trip with a few friends out to Hong Kong, he sort of he went back to the US and offered to pay me in Bitcoin. And I was like, what the hell is that? And he spent months trying to persuade me and explain to me, but looking back with my sort of arrogant, value-orientated investor TradFi hat on, I did not understand it. But I sort of came back to it actually through Ethereum in probably 2017, 2018, and randomly stumbled across MetaMask. I actually can't remember how I got there, but I got to MetaMask and I was like, oh, what's this? And really went down the rabbit hole since then. So I'm a TradFi person who's come to crypto through not Bitcoin, but Ethereum. But after I sort of understood sort of the impacts and what Ethereum does, Bitcoin comes. So I caught the bug and then was still working in TradFi. So I had moved from BlackRock to Amundi and then to Aberdeen, but then decided I really wanted to work in crypto. And I arrived here at ETC Group, which for me is the perfect intersection of the two things I love and I'm most interested in, which is ETFs and crypto. And actually, I see many analogies of sort of how ETFs were perceived in the early days here in Europe when I joined BlackRock and iShares. You know, there were these kind of alien vehicles, which not many investors understood. And you had all the comments that we get today about they're going to blow up the industry, they make no sense, they're creating bubbles, et cetera, et cetera. And actually, ETFs are kind of a very early iteration of, you know, decentralization, permissionlessness in many ways. They kind of really opened up investments and global investments and asset classes like fixed income to investors in a way that's much more kind of peer-to-peer and permissionless, and just allow this fair and equal access. Crypto is sort of 2.0 of that.
Yeah, I'd love to hear it. I'm glad you went down the rabbit hole. I think a lot of people have done the same, and I think very few actually reemerge out of that rabbit hole. A lot of us stay down there. So yeah, let's get into this discussion. You know, I think there's obviously a lot of interest in Bitcoin right now with the success of the ETFs. Personally, myself, I think it's possible that these ETH products could actually be more interesting to investors. So we want to kind of go through in this episode with people really kind of the investment case for Ethereum. We're going to break this discussion into two parts. First part's going to be why Ethereum. So sort of just going through what is Ethereum, Ethereum's business model, you know, what are the network effects, the KPIs and metrics that an investor should be thinking about related to Ethereum. We're going to get into the on-chain financials, the token economics, a lot of exciting stuff just related to why Ethereum. We'll also get into some of the risks and sort of why now. And then in the second part of the show, we're going to get into more of like, how does ETH fit into a diversified portfolio of assets? And so how can an investor think about it in that way? So to kick this off, I think it's helpful because of sort of the interest in Bitcoin right now to sort of just talk a little bit about the difference between an ETH total return staking product versus like a Bitcoin ETF. Maybe you can speak a little bit to that.
Yeah, absolutely. So it's really interesting because I think when a lot of people from TradFi come to crypto, many understand Bitcoin very immediately and quickly and understand it. And many don't get over the hump because actually in the digital gold narrative, many investors don't really like gold because it's not a cash flow producing asset. So it's unfortunate that people stop there, and that because as we know, and as you know, we want to really point out, these are two very different assets. I think the only similarity they share is that they are blockchains really, but they are perfectly and beautifully complementary to each other and they serve completely different purposes. So, you know, Bitcoin is digital gold, store of value, pristine collateral, you know, beautifully simple in what it does. But Ethereum is, as I said, completely different in the sense that it's, in our language, a smart contracts platform, but that may not be so meaningful to someone new to this. But we look at it like a tech platform. I mean, the analogy is, you know, you can look at this like a platform that things are built on top of, and the platform collects revenues off those apps. So you can analogize it to something like the Google Android store or the Apple iOS store, where builders build, they pay tax to effectively Apple or Google to exist there and benefit from the security and the network effects of that ecosystem. But you can take this one step further, and you know, with Ethereum, you can even look at it more like a city or a state in terms of, again, it provides this core infrastructure in a digital realm where builders and users can interact, build things, and it gives you that security, and you pay a tax for it, very simply. So yeah, I think, you know, supercomputer, effectively economic platform, and digital gold and store of value, which I hope most people don't see as very similar.
Right. And obviously it's got that yield. And I think that's the thing that obviously sort of stands out. Well, when you compare it to Bitcoin, if you were to speak to Ethereum's business model, So like sort of getting to just like the core of like, when a user comes on chain, they pay for a transaction fee. Like how does this what's a framework, I guess, you could provide for an investor to sort of think through that process?
Yeah, great question. So again, trying to relate this back to kind of how traditional finance would look at this, it's effectively a user comes onto Ethereum and there's an ecosystem of applications. You can do sort of NFT platforms, asset swap platforms like Uniswap, and many other interesting things on there. And very simply, an investor will interact through a wallet to use those applications. And for the benefit of doing so, they pay a fee. So that's like the revenue. If you look at like a company, that's the revenue it collects. And on the other side of that, people who hold Ethereum, the asset, so it's in this case a payment tool, but on the other side, it's also an asset. So if you hold Ethereum, and we can go into staking later, but when you hold and stake Ethereum, you are sitting on the other side. So you can think of yourself as an equity holder in that platform. So as people and investors use the platform, it collects fees, and the people who hold and stake Ethereum on the other side are like shareholders of that company, if you want to look at it like a tech platform, who are able to do so. So you can think of this like the revenue collected, like sort of dividends in some ways, and you can think of the transaction fees that investors pay. Some of those transaction fees are what they call burnt. So effectively, when you use the Ethereum goes out of circulation forever and ever. And again, economically, from the user and the investor perspective, that's a lot more like a buyback. So you've got this kind of, again, like a company which does dividends on one side through issuance, which stake is received. And on the other side, there is a burn mechanism where transactions are burned, and that's a buyback. So you've got a pretty interesting and incredible flywheel of sort of economic activity there.
Super interesting. I think if anybody, if you're into economics, if you're into technology and sort of economic incentive structures, study Ethereum, because, we think the way that they set up the token economic structure and that flywheel that you just mentioned around user activity, more burn of the token itself, more revenues, fees on the network, and then that brings in more developers and potentially more applications. There's a really interesting flywheel there. So I encourage people to look into that. So moving on to like sort of Ethereum's adoption rates, curious, like what are like the important metrics, I guess, that you are looking at to sort of just confirm that, okay, this thing continues to grow year over year. What metrics, I guess, would you look at in terms of adoption?
Yeah, it's a really great question. And it kind of fits back into how we generally look at products and sort of our mission thesis as a company. So at ETC Group here, we are a very pure and simple business. All we do is issue securitized crypto ETP. So it's kind of the opposite of tokenization. We're taking something that's in the digital realm on chain, we're wrapping it, making it safe and secure for investors, and really building a pipe into this universe through a mechanism which investors are very familiar with, which traditional investors are very familiar with, through the way they trade, the way they settle, the way they work. So our approach to product has always been, we really believe crypto is, one of the most profound social and technological evolutions in line with the internet itself. But being permissionless and decentralized means, there are a lot of things out there which are, quite frankly, scams. And, the tens of thousands of tokens, how do you know what has true potential or true value in terms of delivering some utility for investors? And that's why, we've been very, very conservative about the products we launch. We never launched a Luna product or any sort of dog tokens, which currently have flavor of the month again by the looks of it. But ultimately, that's what we want. We want to bring the best of crypto. We want to be able to filter out all the junk and really bring to investors what is important in this space. And sometimes we might be wrong with that, but that's the approach we take. And that's why Ethereum, was the second product we launched after Bitcoin, because you look at what's going on in there. And I think from a smart contract platform perspective, I think there are a few things you want to look at. First and foremost, obviously, user base. So really the network effect. So the number of active users or number of token holders in that space. But secondly, also, the level of decentralization, because you could have, 1 million tokens of something, but if, half of them are in one wallet, that's not really what, blockchain should really be. But beyond that, you can then look at things like the economic activity. So you look at sort of the TVL on the chain. So the actual value secured in DeFi itself, and then sort of total value secured or transferred or settled, let's say. So how much economic activity is it really supporting? And then beyond that, you start looking at sort of revenues and fees. And that's kind of the approach we take here to sort of looking at smart contract platforms.
Fantastic. Yeah, I think just to maybe drill into it a little bit too, and just looking at like compound annual growth rates, I think across non-zero wallets, just going back to December of 2017, you're looking at 57%, compound annual growth rate just in terms of the number of users on the network, daily active addresses, growing at 22% a year, average revenue per daily active address, I think almost 80% a year. So certainly seeing significant growth year over year within the network, which is awesome to see.
Look, what I really loved, Chan, is that before we started the recording, you told me that you looked into Benjamin Graham's Intelligent Investor. Was that right? Did I get that right? You got into that book?
That is. I was reading on the flight.
So I'm a visiting faculty at a few business schools in India. And one of the subjects that I teach is crypto valuation, crypto assets valuation. And I tell the students how the evolution of value investing framework actually evolved, whether it's Professor Damodaran, who's considered the dean of valuation now. They all go back to the foundation of 1930s book by Benjamin Graham, Security Analysis, right? Like that's the foundation of a lot of traditional valuation metrics. I'm keen to get your take. You touched upon some on-chain metrics that you use for Ethereum, and we cover it week after week on the rundown anyway. But how useful is the foundational knowledge about value investing that you learned in Tradfi and then coming into crypto and applying those knowledge and then valuing these digital assets? The reason why I asked you this question is that I've been hearing a lot more that people are having difficulty finding professionals who understand traditional finance and also understand crypto. You either find TradFis who reject crypto, or you find crypto degens who think that everything is going to go to the moon. So this marriage of the foundational TradFi principles plus marrying it to on-chain metrics is a very, unique combination that we haven't seen a lot of professionals in it. So just curious, since a lot of students watch the podcast as well, how powerful was that foundational knowledge in valuation when you got into digital assets?
Yeah, great question. So initially, when I was introduced to Bitcoin, absolutely zero, because I couldn't apply any of that to Bitcoin. Yeah, there's specific cash flow, and there were these other weird rainbow graphs people looked at, and I'm happy to admit today I just completely didn't get it. Yeah, the analysis to gold is of course the best one, but gold is also hard to value, right? And comes down to supply and demand. Gold has very little economic use, aside from a little bit in phones. And I think the biggest driver of gold is Indian wedding season, right? In terms of demand for gold, so there's a seasonal effect from Indian weddings. But yeah, it was very difficult. And this is why we think, ETH is really interesting and kind of understandable for a traditional finance investor who probably has been grounded in, went through schooling, and if they went through doing things like CFA of, trying to value something fundamentally, which means having a cash flow. So again, once I was sort of introduced to Ethereum and just understanding the economic flywheel we talked about actually produces, we can call it cash flow. It's not cash, but it's similar to, but then you can use that, right? And you can do DCF on Ethereum. You can apply traditional metrics like price earnings and price sales. And again, you can value it like company, and you can actually make a more informed decision putting on that TradFi hat, not just Ethereum, but any sort of smart contract platform which has staking revenue.
Amazing. So just before I ask you questions around tokenomics, just quickly. So DCF, everybody, if they have gone to graduate school and study business, they are told nail DCF. That's the holy grail of doing valuation for publicly listed equities. Do DCF. It's harder to do for, private companies, especially startups who are seed rounds and so forth. But, with the Ethereum, you can do network analysis as well. And whether network demand, value it like a network as well. Not to put you on the spot, but what do you prefer? Do you prefer doing the DCF if you're going to articulate the value proposition and where it could go? Or it's a combination of DCF as well as, looking at the network indicators and maybe global macro as well when looking at the Ethereum price in future?
If I could nail that, I think I'd be an ETH whale today, right? But no, that's why it's such an interesting and fascinating asset, is because it's so multifaceted and you can look at it from so many angles. I think if you were to ask me this question 10 years ago, and if Ethereum were around 10 years ago, I obviously would have said, with Ethereum, with the ecosystem on top of it, having moved to proof of stake and actually having that on top of it, I probably would have said the DCF. But then you look at why a lot of investors sort of missed the boon in growth tech stocks is because no one understood network effects and Metcalfe's law. So, everyone missed Facebook and everyone missed Amazon and Google because they're like, well, when Facebook listed, it had no revenues. So, I think the mentality has changed. I've definitely moved from a value investor to a growth investor in equity world, at least.
Amazing. And look, I think this is a very important distinction to articulate, right? Because a lot of people, they just religiously are like, I'm a value investor. That's the way to value it. Markets don't care. So I think it's very important, especially it's coming from you, a seasoned professional, that one shouldn't really be religious about these valuation frameworks. So thank you for sharing that. Now, the other aspect, which is so unique to crypto, is around tokenomics. And I think if somebody is talking about valuation, especially around digital assets, they cannot not talk about tokenomics. And one of the case studies that I really use to, really hit the message among my students is around the case study of ApeCoin, because when it got launched, it was like so popular. Everybody was like, this is going to go to the moon. And people didn't necessarily study the tokenomics of it. And, that inflation could be a killer when you look at the token unblocks. So I'm curious that considering Ethereum, because it's, evolved so much, went from proof of work to proof of stake, it continues to innovate with its token economics. I would love if you can, articulate a little bit about the token economics about Ethereum, especially considering the recent improvement proposal that came out with 1559.
It's a really great question. This is, I think, where a lot of investors do get burned, and just simply looking at the price number. And tokenomics is an absolutely critical factor. And there are so many projects out there. When you look at the unlock schedule, it's only 10% in circulation. And we're talking about the analogy of buybacks, of the burn being buybacks. This is like new issuance, right? This is like a new stock issuance, which dilutes everyone else. And this is where we think Ethereum really does stand out versus today, versus other smart contract platforms, that it has gone through this evolution. And it'll probably be the only one that went from proof of work, built a network on proof of work and moved to proof of stake, and has created what we think is an amazing economic model, which is, built on basically supply and demand. And it's like, if there is demand for Ethereum and uses for Ethereum, that economics in terms of the burn of tokens, the IP 1559, and the balance of issuance actually sort of feeds directly back very cleanly to holders. And, if Ethereum, people stop using Ethereum, that means, it doesn't work because you have less burn. Tokenomics, you have an inflation coin effectively. So it is, something I don't think anyone's seen in Tradfi. And, when you dig deeper into this, it's amazing. This unique economic model that's been created, it scales with use. And it's a very linear kind of relationship there.
So how often do you go to the website Ultrasound Money to look at the statistics around this?
Quite a lot, because from the first podcasts I sort of got into was Bankless. And that's where I heard that ultrasound money. Yeah, but look, it's obviously it is, the net balance between sort of burn and issuance has been deflationary since the move to proof of stake, and that is really, really important, I think, in terms of the end, fundamentally long term, the end outcome where it goes.
I love what you just said there. I think this is something people should really study. It's new, so it's sort of these foreign concepts. I think are a little bit difficult for people to really wrap their head around, but study this, because I think you just mentioned a few changes to sort of the token economic structure, moving from proof of work to proof of stake, and really what that did to the new issuance of ETH. And then also we just mentioned, the stock buybacks. Those occurred, really kind of in the last cycle. So we haven't seen really what this means in this flywheel we've mentioned in like a real bull market. So I think it's really interesting, and the time to really kind of learn about this stuff is really today. And I think a lot of this token economics actually moves into like an on-chain financial statement. So I want to sort of move into that and talk a little bit about just this on-chain financial statement, how you think about this, how you might sort of describe this to an investor.
So basically, yeah. So what we're looking at here is, from 2015, are we looking here? So to 2023.
All the way back. Yep.
Yeah, all the way back to day one, the ICO. Basically, yeah. So there's two facts. On the top, obviously, you're seeing, the actual revenue. So obviously, when ETH was first, nothing built on top of it. There were no applications on top of it. So there was very, very little revenue. But as ETH evolved and, a greater set and number of applications, actually going back to that, that's another important metric to look at, is actually the number of independent, separate applications built on Ethereum in terms of analyze kind of the richness and the diversity of what's going on there. So yeah, we're looking at, as ETH evolved and, ultimately when we moved to proof of stake a couple of years ago, how that revenue has sort of really hockey sticks in the last few years as that tokenomic model kicks in, and the fees being accruing to stakers.
Yeah, and I think one thing that's super interesting here as well, just to double click on it a little bit, is this: we talk about the token economics, and you really have to sort of understand that, I think, to really understand the fundamentals of the network. But Ethereum actually dropped in revenue during like a crypto winter last year, but it was actually, in terms of like on-chain profitability, it was the first year that it was profitable because of the less issuance and the increase in the burn rates that we just sort of talked about. So really interesting to see this starting to play out here. Let's move on a little bit to like just big picture in terms of the maturation of the industry as a whole, and just kind of where we're at. Crypto's been around for 15 years or so. How do you think about like just the sort of adoption of crypto as an industry, and sort of like why now? Like, are we at potentially at an inflection point in terms of regulation, in terms of the technology itself, the infrastructure that's being built out, the maturation of the space? Are you expecting to see crypto has had a lot of incidents, FTX just a few years ago? Are we expecting more of that? Or do you think we're sort of at the cusp of a turning point for this industry?
I really hope the latter, because I don't think I could deal with another FTX. No, look, I think the spot Bitcoin ETFs in the US, as you know, we've had them in Europe for many years, but the SEC being, the premier regulator and the biggest capital market in the world, that the approval of spot Bitcoin ETFs, and hopefully we can talk about that later, Ethereum soon, and obviously the people who issued those products, that BlackRock and Fidelity have come into this space, that gives this industry, the whole space, a massive tick box. So I think we really are, just at the very beginning, I think, of institutional adoption. If you even go back before the spot ETFs, if you look at, who was sort of trading and using crypto, it was really retail and a few hedge funds on the other side. Very, very few, long-only institutions, asset managers, wealth managers. Yeah. So that ETF, opens the gates and makes it available in a wrapper, again, a recognized, regulated wrapper for all investors, really brings, credibility and sensibility to this space that has not existed before. And now, does that stop another FTX? Technically, no, because again, crypto is permissionless and you can do anything. But I think FTX was disappointing because I think it was very misconstrued as well. It was really a classic Madoff-esque Ponzi. It had nothing to do with crypto. It was repurposing client money and rehypothecating client money and trading with it. It was just a very traditional finance fraud. It just happened to be, sadly for us, in the crypto industry. But I think it probably was good in many ways that it kind of had a shakeout of the space, and the businesses that were not sensible and mature and well run, or, quite frankly, maybe doing things that were not completely legitimate, largely been shaken out. So I think we are in a much better place today. And I can say, personally, working here at ETC Group, that spot Bitcoin ETF has brought us so many questions and interest from investors, we didn't expect to ever really speak to, but everyone is looking at this, everyone is asking questions. And there's a bit of, I think, game theory on the other side, that I'm on a crypto podcast, I say most fund managers are sheep. So I'd probably alienate them now, but ultimately all it takes is, one big multi-asset fund to allocate, and then they outperform their peers. And from my career, I know how closely they look at themselves versus each other and their relative performance. So all it takes is one, and then, they start attracting the client money from their competitors, and then their competitors will have to look at this. And I think, again, once you look at this space seriously and sort of don't do the cursory thing of look at Bitcoin, don't get it, walk away, I think, there is huge potential floodgates of investors who are just entering the space.
Super interesting. So potentially some FOMO from the institutions, Shiv. You heard that?
Yeah.
I'm going to go boat.
I just tweeted today. I know Michael felt anxious after it, but now that you mentioned a little bit about Terra Luna and all, I hope you don't get anxious. But I tweeted today, considering the market fluctuations, that steady lads deploying more capital. But I think
Don't go there. Yeah.
But I think we speak every week around this as well. Like, it's just the start, right? Institutions have just coming on. I have a lot of questions around the asset management business, which probably we'll do another episode and get you on just to understand the digital assets management business and, the competition around it. But I think a good segue now, since we are so hyped up about the FOMO of institutional demand, is now talk about risks like any prudent investor would. And we should articulate it to our audience as well. A lot of people think that I'm a cynical person, but I think Michael would agree that I'm not cynical. It's more of a realism that we should have as well, especially in the current climate, right? Like where the flow-on effect of Bitcoin is now translating into meme coin fest, where everything is they're getting a volume of billions of dollars on exchanges, these meme coins and all that. So shifting back to the Ethereum spot ETF, though, especially the innovative product that you have introduced, what are some of the risks that as issuers that you are looking at as well and monitoring and articulating to your investors as well? Like, I'm pretty sure there would be things like around the competition, because as we know now, Solana has got more volume, more on-chain volume in comparison to Ethereum. So things like competition, things like the smart contract technicality with these improvement proposals, scalability potentially eventually, and also like what would happen in US if, let's say, Ethereum spot ETF doesn't get approved for whatever reason. So regulatory, risks as well. How do you package all this in a risk management framework and articulate it to your investors, and also like value it when you're articulating the value proposition of your product?
It's a really great question because, there are many, many risks in this space. Yeah, now we've just talked about, the bullish side of the adoption, but yeah, absolutely. From the level of smart contracts to tokenomics to hacks to, protocol versus protocol, as you said, competition, etc. So look, we can kind of separate. I think in this case, you can separate Bitcoin out. In terms of competition, we think that the competition risk is really not there. There are, of course, still other risks in terms of, the fee model, in terms of, over a long term, how does it sustain itself, without sort of other on-chain activity. But I think, I believe in the engineers in this space and the developers, and I think, that will be solved. So coming to smart contracts, yeah. So the first one is absolutely inherent smart contract risk. But here we think, Ethereum has, proven how robust it is. That's why we do believe, institutions will build on this chain. And we're seeing that already. We've seen many TradFi banks, pilot things like bond issuances on chain on Ethereum. And that's because it's so stable and robust. There's no downtime. But there are other chains and, very few things in this world end up in a complete monopoly. I can't think of any industry. I think I read somewhere the closest is De Beers with diamonds. And they have the 75% market share. These things will end up naturally organized in oligopolies, I think you'll find. So there will be 2, 3, 4, 5 chains that will be here to stay and will, ultimately have the majority of economic activity built upon them. Yeah, we think Solana's fantastic. We have a Solana product as well. And I think the interesting element here is their respective approaches to scaling, right? Modular versus monolithic, and how they're trying to solve the blockchain trilemma between decentralization, security, and scalability. And I think, the analogy is there's more than one way to skin a cat. I think there's no right or wrong approach here. But certainly, the risk for Ethereum, if we focus on that for a moment, Vitalik's urges, that is a lot of development work. And, there was a lot of perceived risk around the migration to proof of stake. I think I heard someone say it was like changing 2 engines on a plane midair, but they executed, which is amazing. But even, we had EIP 4844 last week, risks. And every evolution you make, there is a risk of, forks, chain breaking, chain going down. So that has to be, you have to explain to investors that this is not the only one. There are risks to all of these. And similarly, Solana, fantastic. And especially with, what they've done or what's going to happen with the fire dancer upgrade, if promised, that throughput is absolutely game changing. But I think where this goes is different apps get built on different chains depending on the needs of users. I think lower value things that, require speed of execution, things like high frequency trading to small size, but gaming, in-game assets. Yes, Solana seems to make a lot more sense. even for dog tokens recently. So Solana seems to have won that narrative for the moment. But we think, higher value things where there is a lot of economic or financial assets at stake, we think get built in Ethereum, because those gas fees are meaningless. When you $1 billion transaction, $200 gas fees is meaningless in that sense. But of course, the Ethereum modular scaling, is heavily reliant on layer twos, which are all independent, kind of competing businesses, and the interoperability becomes complex. The moving between one layer two to another layer two is not easy. The UX is not perfect and far from it, and that's where Solana is actually great. The UX and the simplicity of use is absolutely brilliant. And so there are a lot of risks. Also, trying to get all these different layer twos to share a sequencer and agree to a shared sequencer, that's trying to get them to cooperate where they're competing. But I hope in this case the spirit of crypto about being collaborative and working together to solve problems. And then you've got other approaches like the Cosmos SDK, very, very different approach. But then we don't know how the economic model works there really, because the accrual to Cosmos token holders, Atom holders, is how do you kind of accrue revenue there? So various approaches, various risks. But I think ultimately 3 or 4 win out, and we do believe Ethereum. We increasingly believe Solana will be the second. Really interesting to see what the other 2 or 3 will be and what evolves. Yeah, because we think obviously again, which we didn't expect really. We thought the layer 1 sort of trade was done in 2021, but we're seeing some really interesting new layer 1s come out, like SUI and things like this, which are taking a different approach, different coding language. So yeah, lots of peril and risk on the way, lots to be resolved, but I think I'm confident that this space kind of gets there.
Got it. Before we move on, just a quick question. And do the clients, or does the question around decentralization come in? Like, is that also part of the risk that because Ethereum moved to proof of stake, how centralized the staking would be through a staking provider? Is that also considered as part of the risks or no?
For sure. It's a question we've been asked, but we think actually Ethereum is very, very decentralized and secure. And I read a recent paper, and I apologize to the writers of the paper, but it was about, the cost to attack a network. And if you look at it like that in terms of, how much Ethereum is staked, it's actually more difficult and expensive to kind of attack or take a, 33% attack on Ethereum versus even Bitcoin, actually. But yeah, for sure, that is important. But then I think this is where Solana has an issue that, the complexity and cost and the hardware required to be a validator on Solana is much, much higher. So, you can't be single solo staker as you can on Ethereum, but then also 32 Ethereum minimum is an extremely high amount for most individual investors, and especially if the price keeps going up, that becomes harder and harder for most to be, solo stakers and bring that true decentralization to the network. But I think it varies between investors. So I think if you're more of a purist, and some investors are purists, then they care about that, because that's ultimately the promise of crypto is, I think for us, it's decentralization and permissionlessness. That's what makes it different and unique. But for others, as I said, it's more about, they don't really care as long as it's kind of secure and their assets secure, and the things like transaction speeds and, being able to, the UX become more important. So it's mixed. And I think what you find, especially with investors here in Europe, very interesting, because the products in the traditional finance ETP wrapper have been around for a few years, in terms of how far apart 2 very similar investors on the surface, let's say like a regional private bank or a big private bank in Europe, who look very similar. I won't name names, but who look very similar from the front, but how different they are in terms of how deep and advanced they are into crypto. We know some very big investors who are using ETPs, but also actually building their own wallet infrastructure and actually going on chain themselves. And that's extremely advanced. Whereas others still wouldn't know the difference between Bitcoin and Ethereum. So it's a very widespread.
Got it. Thanks for that. Cool. Over to you, Michael.
Yeah, always good to go through the risks. No upside, no risk, right? That's part of the game we're playing, right?
Yeah, absolutely. Which is interesting, because I'll just touch upon something interesting, because we've been asked by some investors over the last years about doing things like protected put or, structures or vol control. It's interesting, but we kind of also, the volatility is the price you pay for the asymmetric upside as well, and kind of what's the point? But we get it, because, many multi-asset portfolios themselves have a risk target or a vol target. So putting something like this into that fund completely skews the performance and the outcome. So I can understand why someone would want exposure to this in a well-controlled way, but we kind of think it also defeats the purpose in some ways.
So I think we covered the first section of this interview, but I want to move into really kind of how this fits into a portfolio and how an investor can think about the asset within a diversified portfolio of assets. And I think maybe to start off, we talked a little bit about just, how would you bucket this asset? Ethereum is interesting because it has features. I like the Robert Greer super asset class framework where you have the capital asset, commodity asset, and store of value asset. And from my perspective, Ethereum actually sort of fits into all three of those buckets. But I'm curious how you would articulate how we should think about Ethereum as an asset.
That's why it's such a fascinating asset, because it is so multifaceted and it does fit into all of those buckets. But I think if you were sort of approaching this very simplistically to a newish investor from quite first principles, I think we go back to where we started. And this looks very much like the internet itself, or a tech platform built on top of the internet. And some people see this as the value layer of the internet. So you can look at it through the lens of an equity, of a dividend-paying equity, which does buybacks. And I think that's a good, sensible starting point from our perspective. And it's an interesting time to look at this as well, because given obviously equity markets, specifically the Nasdaq, kind of, we all know Magnificent Seven, how skewed those indices are and how, overvalued. We don't think this is a .com because Nvidia and Apple and Tesla all are, have very strong cash flows and revenues and a robust business. They're not pets.com, but at the same time, you can't get away from the fact that the equity market's very stretched. And kind of if you go purist and the future that, Ethereum is a foundation layer of Web3, the web of read, write, and own, and it ultimately could also disrupt the likes of Google, Meta, et cetera, makes a very natural fit to sort of take some of your equity allocation and put it into Ethereum. It's a disruptor. It has similar characteristics. The Nasdaq's pretty high vol asset as an index. This is high vol. So I think that's where we'd start. But again, you can look at this like the internet bond and the risk-free rate of the internet. Maybe not yet, but as this asset class matures and vol comes down, that's where it could go. But I think sensibly it probably comes from equity allocation in a 60-40 or a multi-asset portfolio. And we can look at so what and the asymmetry of an impact even a 1 or 2% allocation has there.
Super interesting. And I think thinking about it in terms of correlations, we've looked at, how does ETH correlated to Bitcoin and other crypto assets? And then how do you think about it in terms of its correlations to other 60-40 portfolio, how it kind of can fit in and how an investor can think about, diversification?
So look, I think intra-crypto correlation is still pretty high, but I think anecdotally we're seeing compared to the last cycle, it's not that everything is moving in the same direction on the same day in kind of the same rough magnitude. I think we are seeing a lot of divergences, between crypto and in terms of, versus other asset classes as well. There was a narrative that, this is kind of, just the next leg on the risk spectrum after NASDAQ. But if you look at these correlations, they change sign and, it's like the bond equity correlation. Everyone seems to think that it's permanently, long-term, historically negative, but it's changed signs very frequently. So you can't just say it's sort of one narrative it's highly correlated, as we can see from this chart, and it can change. And again, Ethereum and smart contract platforms, they're driven by a unique, different source of kind of risk and return. If you're looking from a factor regression perspective, if you regress this versus traditional equity factors, I think you find quite a high unexplained percentage, and that's really interesting as well. So you've got obviously numeric correlation, but you've also got this factor correlation, which we think is, and we've looked at a little bit, but it is very different in terms of, if you look at it versus momentum value and other equity factors and just do a regression, you get a low R squared basically, and then a high unexplained.
Interesting. Shiv, did you want to jump in here?
Yeah. So I'm really interested, to get your take on the staking versus holding topic around the impact on returns. Like, of course, there is there would be an Ethereum product that would offer staking, and then there would be Ethereum product that would not offer staking. So from your perspective, how do you think those two different Ethereum products are going to work out in an ETF format for investors?
Well, we actually have a non-staked Ethereum product. We've had it for many years. And I think for us, it's actually just empowering investors and giving them choice. We can understand why for some investors just coming into the space for the first time, staking is a whole nother world of data, information, risky you need to look at. And, the asset itself is one level, and then, that's a second step, right? So I think offering investors and giving investors choice between both is important. So that's what we will maintain having both products. And I think a lot of investors, a high minority, will still prefer non-stake. Obviously, on a highly volatile asset class, which can do, 100%, 200% in a year, 4% seems pretty meager and meaningless, but then compounding is the eighth wonder of the world. I think misattributed to Einstein. Maybe it was him, who knows? But that for a long-term investor, that is important. And again, as this asset class matures over the next years, the volatility will naturally come down, and then the contribution to return from staking becomes more important. Yeah, I think offering both is sensible and wise, and investors, should be empowered to make their own choices.
Got it. Now, I know that both you and Michael collaborated on doing some number crunching valuations and looking at, the impact of Ethereum historically on a 60-40 portfolio, and also what would be the impact on returns while just holding an ETH non-staking product and a staking product. And I would just love to listen from both of you, on the Ethereum assets impact on both the 60-40 portfolio in the eventual returns, and also the staking versus non-staking when we go to the mathematics, because you both have collaborated and did some analysis about it.
Here we are, yeah. And for people that are listening here, we're pulling up some numbers on our end, and we worked with ETC Group a little bit and collaborated on this report. And what we can see is that, when you look at the impact of just adding, 1% or 2.5% or 5% to a portfolio, you can boost your returns while also keeping the volatility fairly low, which is really kind of the interesting takeaway here. But Chan, I'm going to pass it to you. How would you sort of speak to this? And we back tested, really going back to August of 2015 all the way through February of 2024. So decent amount of data here. But yeah, curious how you would speak to just, the boost. It's sort of like a little hot sauce on the portfolio while also not really impacting the volatility too much.
Yeah. The hot sauce will not make you too spicy and unpalatable. Definitely. The right amount. I mean, it's exactly that. It's beautifully simple, but it's so asymmetric. You are, for a 5% allocation, you've effectively doubled your annualized return for a 2% increase in vol. And if you look at the Sharpe ratio, which is the traditional metric, that is an incredible boost. And I think the other thing, again, coming back to investors, the yield element of this, the source of yield is also uncorrelated, right, to rate, to interest rates and bonds, and to equity yields and to inflation. So you can look at that as another independent strip out of, if you are a yield requiring investor. And longer term, if we hope and think that pension funds and insurers, with liabilities, come into the asset class, that's quite interesting and important as well, in terms of, you have this yield that is uncorrelated to bond yields, driven by, again, different factors. But yeah, very simply, asymmetric, right? So return goes up a lot, volatility goes up only a little bit, and also actually the max drawdown, which is a very important element. So I think, again, for traditional investors, drawdown for many investors is too big or has too big an impact, becomes quite unpalatable if you add that into your portfolio. So your max drawdown, again, is hardly impacted, going just shy of 25% to 27%, pretty tiny.
It definitely looks pretty good historically. Obviously, this is not investment advice for people. We're talking a lot about, historical returns. The past does not always predict the future, obviously, but I want to talk a little bit about your products now and move into, I think there's been a number of ETF applicants in the US. I did just see that Fidelity requested staking to be added to their product just yesterday. But would love to speak a little bit about the ETC Group product that you recently released out into the market.
We've spent an incredible amount of time and work. I think it's, over a year and a bit in the making we hope to get this as good and as transparent, as sensible and as high quality as possible for investors, basically. I think that the real element is, you have the staking rewards, but you also have to make them safe, and you have to appreciate investors have choice. So there are many investors, good subset, who can kind of, solo stake potentially, but also use liquid staking derivatives. There are other ETPs in the market. So what we really wanted to make this product is stand out against all of them and be best solution when it comes to that trade-off between sort of liquidity, transparency, investor outcome. And really one important element, and we're the first ones to do this, is having a benchmark. Seems pretty simple and sort of not that important, but for institutional investors, be able to measure your returns against something that's kind of at least representative of what you should be getting is highly, highly important. And I can't reiterate, how this kind of been missed by many. And that was a real challenge because, as we know, the nature of ETH rewards are not consistent and stable. You have the consensus rewards. Okay, that's what everyone gets. But then you have execution layer, and then you have this other beast called MEV. So actually finding sensible benchmark, sensible index, which is representative and fair, but also achievable, was a really difficult task. And we worked closely with a lot of index providers and finally worked with Compass. We thought had the best methodology in terms of, giving you something that an investor can hold our product, look at and say, okay, I'm achieving a fair outcome through this product. So that's really important. But also through our other partners, I have to speak about Zodia, our custodian, and Block Demon, who are our staking provider on this product, who've been, really held a hand on this journey. And, we couldn't really have not done it without them.
And then I think just speaking a little bit too, maybe as we sort of start to wrap this up a little bit, there's obviously a number of other, ways that investors could potentially access the yield within the Ethereum network. There's DeFi, right? So there's solutions like Lido out there where it's self-custody and you're interacting directly with smart contracts, maybe a little bit more risk there. There is other institutional staking derivative products out there. There's solo staking. When you guys speak to investors, I'm curious how you would articulate the differences here and kind of why you think this regulated total return product you're putting out there could be interesting from that perspective.
Yeah, absolutely. And look, it's never one size fits absolutely everyone, but we wanted to be able to address and make this as relevant for as many investors as possible. And look, I think there's quite a few factors here, right? So first and foremost, it's liquidity, I guess. So with many staking solutions, you don't have the liquidity. So if you're, doing a direct staking with a staking provider, like an institutional grade provider, or if you're solo staking, you don't have the liquidity there. LSDs, liquid staking derivatives, do give you that liquidity. But then there are other factors, like things like slashing risk, what your minimum investment size are, what your rewards, sort of the probability of achieving rewards are as well. One of the benefits of the ETF is because, the validators are separate. So you don't have the same risk as a liquid staking derivative, that the validators are segregated and you can go, on chain and look at the validators we run. Basically, but also on the other side, in a pooled product, you increase your probability of receiving rewards. So if you're a small investor, you benefit from the bigger investors than us having more validators run under the chain to get a better outcome than solo staking. So that's very important. Fees, of course, are really important, and I think that's where again we want to have something that gives hopefully the best investor outcomes. So the fees we take, we've been very transparent about our management fees, but also the percentage of the staking rewards we keep. And for us, the number is 10%. And that's quite a bit lower than many other solutions. And some of the solutions out there are quite opaque about what they take. Other factors, passing on rewards, is the MEV reward element being passed on. Again, in our case, we're passing everything back as well. The benchmark, and then slashing risk, things like that as well. There's a lot of risk to running your solo validator. If you're down, you could be slashed. Right? So there's so many elements, but we've tried to take all of those into consideration and build, what we think is hopefully the optimal solution for most.
I'm curious on the redemption side. Is it an in-kind redemption, or are you getting?
Because obviously the spot Bitcoin ETFs in the US are stipulated by the SEC to do cash creation redemption, which creates a lot of friction actually when it comes to coming in and out of those products. Here in Europe, we do in-kind. So most issuers are able to offer both. In-kind makes it actually a lot easier for our partners, the authorized participants, in terms of being able to go out and source that underlying ETH or Bitcoin more flexibly rather than having to execute versus a specific benchmark at a specific time where liquidity gravitates in competition. So the in-kind element is very important. And I think another really unique factor for us here at ETC Group is we actually do offer direct redemptions to investors. So if an investor wants to directly redeem the ETH or the Bitcoin, they can come to us and do so. That's a very important element that I think makes us very unique in the space.
Super interesting. I don't know. I can't believe we don't have these products over in the US just yet. Well, I mean, this is fantastic. I guess to wrap this up, I would love to know, you guys released this product, a couple of weeks back. How's it going? You guys also have a Bitcoin product in the market. We'd love for you to just share a little bit about what you're seeing from the reception in the market currently.
Absolutely. I think obviously after January 10th in the US, a lot of eyes on Bitcoin, and that's been fantastic. I said for the European market, we do of course look to the US and what's happening there. The US does lead in many elements. So as I said earlier, the approved those products has really brought investor eyes and attention. And now we think, the depth of research and time that it requires. So we've seen a huge amount of investors sort of speak with us and our peers about looking at this space and helping them on the journey. And with the ETH product, it's been incredible for us. So it's probably been our best product launch ever. Usually these things take time to scale. It's very hard to get from 0 to 1 million and 10 million. But we're very proud to say, we reached about $25 million in assets in a couple of weeks. So super happy. And thank you very much. And, hopefully testament to the product and all the work we've put into it and the team here.
Amazing. And, what's next, I guess? And are there any guardrails coming from the regulator over there where you guys are trying to push the boundaries a little bit and just waiting on more regulation? Or is it just a matter of rolling out the next new product?
There is regulation, and the way Europe works is it's obviously kind of one market, but it's not. So we have this kind of overarching regulation across the EU, which are led by these guidelines called ESMA guidelines, which feed into a mechanism called UCITS, which is kind of our equivalent of 40 Act, which is really a framework for collective investment vehicles for them to be kind of regulated under that umbrella. So unfortunately, under that and for the single underlying product, because of technicalities around those UCITS guidelines, means we can't call them funds, sadly. So hence we have to call them ETPs. But structurally, we can't reiterate enough that they offer the exact same mechanism and security to investors. They're 100% backed by the crypto, held in cold storage. For our Bitcoin and Ethereum products, you can go to our websites, and not just us, actually, all of our peers and competitors, and you can look at the wallet addresses and see that the Bitcoin is actually there. So the Europe is kind of 2-3 speed. We've seen sort of Germany really be at the forefront in terms of from a regulatory perspective, in terms of, approving these products and allowing investor access. The UK is sadly a little bit behind, but we're seeing some positive steps in terms of regulation and regime around listing the products yet. But sadly, in the UK, you still can't offer these products to retail investors, which we do find a bit crazy that someone can go on Coinbase or Kraken or anywhere else and buy these products. They can't through a MiFID regulated security. So, but it'll happen. We understand it. It's difficult for regulators too, right? It's something that's kind of if you look at the speed of this asset class and where it's come from and how quickly it's grown, we understand the challenges they face as well. So it's all about hopefully being able to help them on their journeys too. But look, in terms of the product, I think the way we see it is probably 80% of assets in crypto are going to go to Bitcoin, Ethereum, diversified basket products. And I think that's really important. I think a lot of investors who come late to this space and maybe have, very limited internal resources to do initially all the work that's required, but they want to allocate. Actually, a diversified, simple market cap product is sensible and the best thing to do. And we've had a very, very good product, which we benchmarked with MSCI, which looks at the top 20 tokens, excludes dog tokens, because we don't think dog tokens and meme coins are a way to get to institutional investors and show that this space is really sensible and grown up, but it's stable coins. And importantly, the unique design factor in our index product is we've actually capped the allocation to Bitcoin and Ethereum to 30%, because obviously, it's a bit like the NASDAQ in some ways. It's the market structure is so skewed in terms of market cap. You have, Bitcoin huge, Ethereum very big, and then a tail, really, if you look at it, the additive market cap. So capping those two and really getting better exposure to things like Solana and Chainlink and other very sensible and solid projects, we think makes sense if you want to really capture the space. Because if you go uncapped, you might as well just go and buy Bitcoin and Ethereum and be done with it. 97% of your total return and risk are going to come from those two allocations. But we think beyond that, Solana looks very much the kind of next institutional grade single asset. And then so many interesting things. It's really hard to say. But, we think Chainlink is super interesting and important in terms of the interoperability of the Oracle network and a critical piece of infrastructure for the whole space to be able to grow and succeed. So that's something we're looking at and thinking about.
Amazing. Yeah, it's kind of been my, I guess, sort of high level thesis that, we're in this sort of phase one of sort of the merger of traditional finance and crypto. And it kind of starts with all these interesting products that we're going to start to see come to market. And I think hopefully, if this really plays out the way we think it will with the maturation of the tech, ultimately you actually get the entire rails being used to conduct, finance over time. So super exciting times ahead, it sounds like. Shiv, anything on your end before we wrap this up?
I think this was great. We spoke for like more than an hour. It's never enough whenever we get guests. And I think we should have you more often to get quarterly update on how, the institutional products and digital assets is doing in Europe. So this was a delight for me, and I think, judging by Michael's reaction, it has been a delight for him as well. So it was our pleasure to host you. And thanks a lot for really innovating as well. Yeah, it's interesting, right? Like whenever something happens from a financial manufacturing of products perspective, US is not really at the forefront. It generally, innovation would happen maybe in Europe. Like you said, Bitcoin spot ETF was there already. Canada launched Bitcoin spot ETF earlier as well. But it's only when US launches and approves these products, that's when the big bang moment happens. And suddenly everybody else are like, what were we doing? Why didn't we invest in it? So it's kudos to innovators like yourself and ETC Group that kind of paved the way. And then they then make sure that the US institutional manufacturers of these financial products are become aware of what's happening around the world. And they're like, we should look into it. And then they manufacture in the world is like, oh yeah, this was an overnight success, but that is not true. So congratulations on, the launch. Congratulations on the success. Can't wait to keep on having discussions around this because this is an ever-evolving space in digital assets, and look forward to learning more from you around this.
Thank you, guys. Really great to be on here. Had a blast. So thank you so much. And I'll leave with one last comment, actually. People think that the first ETF was in the US, but it was actually Canada. And coming back to exactly what you said, Shiv, everyone sort of goes to the US, and that's where the market, of course, grew and matured, but the first ETF was launched in Canada. But yeah, guys, had a really great time with you guys. Thank you so much for having me. I look forward to speaking again soon.
It was entirely our pleasure. For people out there, where should they go to check out about you and ETC Group? Where should our Rundown viewers and DeFi Report viewers should go?
They should go to our website, first of all, is etcgroup.com. We're on all the socials. You can find us on LinkedIn, where we're mainly more active because we are generally speaking to institutional investors. You can find me there. You can find my fantastic colleagues. Sometimes on Twitter. Should be tweeting more.
Amazing. Well, thanks again for coming on, Chan. Thanks for paving the way for the US as well. And yeah, hopefully we'll have you on again, maybe in 6 months, and then learn more about assets under management, how things are going as we move through this cycle here. So awesome.
Thanks a lot, everyone, for tuning in. And let us know, would you like this episode or not? Put us in our comments. But thanks a lot again, Chen. And thanks a lot, Michael, as always.
Thanks, everybody.